exciting year we've had. It seems to be an exciting year on top of a bunch of exciting years. So I'm looking forward to this conversation. I think before we begin, can you start again by please welcoming Sharon Zollner from ANZ, Mark Lister from Craig's Investment Partners, and Kelvin Davidson from CoreLogic New Zealand. So welcome. Thank you very much for your time.
Thank you.
I'm Mark Benicevic from Partners Life, and my challenge is over the next 40 minutes to try and extract as much great information out of these fantastic minds as I can. So I'm going to start with one opening question, and I'm going to ask the same question from each of you, starting with you, Mark. Can you please reflect on 2023 and then look forward to 2024? What have we seen and what can we expect? How confident are you in your predictions?
Right, well, looking back on last year, I think generally the global economy probably held up better than many people expected across the board. The wheels didn't fall off, and that was contrary to numerous risks and lots of expectations of it being a very difficult one. China was probably the big disappointment. We didn't get that reopening story that we hoped for, and that is still a country, a very important one to New Zealand, that's in a difficult spot. At the other end of the spectrum, you had the US that powered ahead, was very resilient, and still looks much stronger than many others. So that was sort of the economic backdrop, I guess. In terms of investments, which is my wheelhouse, it was a fantastic year. Despite all the nervousness, all the doom and gloom, global shares were up more than 20% last year, which is more than double the long-term average, led by the US, led by Japan. New Zealand a little bit more subdued, but it was generally a pretty positive environment. And I think even here in New Zealand, you had fixed income deliver the best return that we've seen in almost a decade. So a surprisingly positive year despite a difficult backdrop, and the lesson there, I suppose, is that even when there is a long list of things to worry about, which there always is, you still have to take some action or at least sort of hedge your bets. Fast forward to this year, I guess there are some positives. You know, in my opinion, inflation has peaked everywhere and will keep heading down. Interest rates have also peaked pretty much everywhere except Japan, and this will be the year that we do see declines, you know, maybe not as early or in the same magnitude that some are hoping for, but we will see declines. Those are really important tailwinds for the global economy and for investment returns. So I think it is a year where we can still see some strong performances from many asset classes. There's still a lot of risks and a lot of challenges. Will we see a US recession? It's certainly not unavoidable, but you know, there is a reasonable chance that we do see those high interest rates catch up with the world's biggest economy. China's still in a difficult spot, and there's geopolitical risks with the US election, with all the tension you're seeing in the Middle East and so forth. So I feel like we will have a better year than many are expecting, albeit maybe not as strong in places as we saw last year. Although, you know, you touched on the level of confidence, and I still think, I feel like I have a low level of confidence in many ways because there are a lot of things that are up in the air, and a lot might depend how quickly some of the world's central banks, most notably the Federal Reserve, choose to take some action. So I think it's still a year, we're not out of the woods, and it's still a year to sort of be a little bit cautious.
Great, thanks Mark. Sharon?
Well, last year obviously wasn't easy. We've seen some GDP numbers that show that per capita GDP fell 3% in the year to September last year. So absolutely can't minimise that some people have been doing it really tough. But for businesses, I think the theme for last year was, actually, it's not as bad as we thought it was going to be. The trough of all our business sentiment and activity indicators was in November 2022, when the Reserve Bank basically admitted they were going to deliberately cause a recession and hike the official cash rate 75 points in one hit. That was quite, people were reeling after that. But the theme of last year was, actually, for businesses at least, this isn't as bad as we thought it was going to be. And partly I think that reflects that while the New Zealand economy was horrifically overheated, it wasn't on the back of booming private sector credit. It was booming public sector debt. And so we haven't had that hangover. And you can see it in the likes of mortgage default rates and stuff have been very muted, even though we've had the most insane housing cycle that we've ever seen. So the hangover hasn't been as bad. And so that is genuine good news if we've had enough pain to sort out inflation. And that is not a given. It's not a slam dunk. This is the next year is the year we find out, has the Reserve Bank done enough? Is it really all over bar the shouting? It's just worth remembering in the cycle that ended 2008, they paused and hiked again twice. So if we do end up in a situation where they come back for another go, it would not be unprecedented. It's not our expectation. Inflation is falling. Is it falling fast enough? Obviously global inflation could turn around and deal us another blow, while that baseline inflation, domestic inflation, is still pretty high. That's the concern. Shipping costs are spiking again. Oil prices, fine for now, but obviously the risks are hard to miss. So I think, 2024, no, don't trust anyone's forecast about, I would say about this year. Be nimble, because we are still, it's a nuanced situation. We've made good progress on inflation, but we're not there yet. Central banks are still nervous, and obviously the global environment could throw some curveballs. But so far so good. We'll end on a positive note. Yeah.
We're in January, yes. Thanks, Sharon. Kelvin, you'll kick off.
Yeah, thanks. So my lens is property, so I pretty much talk about the housing market. I mean, everyone lives somewhere, so we all kind of know what happened last year. We called it a year of two halves. First half of the year was obviously pretty quiet for house sales. In fact, like a 40-year low for house sales. And house prices still falling a bit more. Get into the second half of the year, some of those things turned around. Migration's obviously very high. Mortgage rates stopped increasing. What else? We had LVRs and triple CFA loosened. So started to see signs of that turning around. Now it's continuing. I mean, it's a bit patchy from month to month, region to region, but at least it's continuing. So I think that's the sort of environment we're in for 2024, more sort of housing market recovery. I mean, the New Zealand economy has been called a housing market with some other bits and pieces, so it's pretty important. I suppose for me, I mean, there's lots of themes, but I'd pick out maybe three things. One is regulation. We've heard triple CFA talked about. We know LVR is going to be loosened. I mean, it's consultation, but it's going to happen, you would say. And what else? DTI is coming in. Now, net effect of all that on the property market, probably upwards, because DTIs aren't going to do much straight away. LVR's loosened. They're especially binding at the moment for investors. And we've seen how investors react historically when LVRs are loosened. So I think that could be not saying it's a big thing, because there's other restraints on investors, but at least some kind of boost. And it sounds like triple CFA is going to be a boost as well. So regulation, probably net positive. How first home buyers and investors kind of react in that environment. First home buyers have been pretty strong. May not always have it their way if things are turning a little bit more towards investors' favour, or that we could see their market share rise back again. And then within all of that, you've still got mortgage repricing. Everybody's starting to talk now about maybe some OCR cuts, but we've actually still got effectively monetary policy tightening to come, because I know I'm still on a fixed rate from a couple of years ago. I've got to get up to maybe 7% still, and there's a lot of people out there in that boat. So yep, regulation, different buyer groups, and that repricing is, I think, still something to watch for 6 months. Getting into the second half of the year, we might be through the worst of it. So overall a kind of subdued year, but recovery continuing.
What do the stats tell us about what portion of New Zealanders are still coming off their fixed rates?
Yeah, so we don't know from the Reserve Bank stats when people took out their loans, so that makes it a bit hard to quantify like the interest rate change they might be looking at. But we know right now, if you look at it by value of mortgages, there's about 55% currently fixed and due to see a rate repricing in the next 12 months. And it's pretty evenly spaced out across that year, so it's kind of, 27% in the first 6 months and 27% second 6 months. So yeah, there's a lot. Now, we don't know what the interest rate change is. The kind of best guess is you look at the average rate across the stock of fixed loans, which is sort of 5.5%. Look at market rates. Who knows where they'll be in the second half of the year? But right now, if you're saying, let's say it's 7-ish, then there's another 1.5% to go. So pretty substantial. It's definitely a theme to watch for sure.
So potentially up to half of the mortgage stock could be coming off refixed within this next 12 months. Some of them may be on short-term fix that have already felt the pain a little bit, but a huge portion of it's still to come.
Yep. Yeah, and people will have had one or two repricings already. This is always going on. I mean, it's nothing new. There's always 40-50% on a sort of 12-month rolling horizon, but it's not always facing a 1.5% interest rate increase. So I think that's the thing there. As Sharon said, we're just not seeing mortgagee sales. I think in the last quarter there was like 20 mortgagee sales across the whole country. After the GFC, that was like 800 in a quarter. So mortgagee sales aren't there. Non-performing loans are basically nothing. Labour market's been massive in supporting that. People have had work, so not easy, but they'll make it work. So I mean, I'm pretty optimistic that we'll get through that. It's been pretty good so far. And people should be aware at least that their rate repricing is coming up. But I think, a lot hinges on the labour market. There's some risks out there in terms of some job losses. So, for me, that's a big thing to keep watching, and it kind of reinforces this whole, patchiness. And I mean, I didn't answer the question about how confident I am. I mean, I'm probably the same, you never be too confident. But there's some good reasons to think that we'll see that upturn continue, but with caution.
Great. Okay. Thank you, Sharon. Just to follow on from that point about the debt to income ratios, the Reserve Bank, I think, was suggesting about 6 times income, gross income. What are your thoughts on the impact that may have on the mortgage and housing market?
Right now, very little, and that is by their nature and by design. Essentially, they will kick in when the house prices, when interest rates are low, and so then the constraint becomes the multiple of your income. At the moment, when interest rates are high, it's servicing the debt is the constraints. You cannot borrow at a debt to income limit that's above that level anyway, typically. They're unlike the LVRs, which are likely to be tweaked pretty constantly. The debt to income limits are more of the set and forget variety. Of course, we can't go back and say, if only we'd had these in 2021, the world would have been different, because I mean the LVR restrictions were suspended for 12 months, and then there was a real scramble to get them back on. So we don't know what would have happened had we had these, but there was certainly a significant proportion of lending at that time was at the rates above where these guardrails are being set now. It's basically designed for the sort of scenario where the Reserve Bank feels the need to keep interest rates very, very low, but nonetheless is worried about the quality, the quantity of riskier lending that is going on. Important to note, they're not monetary policy tools, but in most circumstances you would imagine that kind of scenario could be a sort of inflationary environment anyway. Overall, there's a lot of overlap between the debt to income limits and the LVR limits. It's a bit more nuance, but probably it's not designed to be a game changer. It's not designed to have a big impact on credit availability on average over the cycle, and we don't expect it to.
It would be interesting to know how many Aucklanders could afford a house at 6 times their income.
Well, some countries, they set the limit a lot lower.
Yes.
I was talking to someone in Norway and they said, our limit is 5. And I thought, oh, you impose that on the New Zealand market, you would certainly have an impact on the house prices.
I just want to go a bit global again now. We've had a really turbulent, well, I can't remember the last non-turbulent year we had. We had, Trump elected, then we had COVID-19. We've had Ukraine's now in the second year of its war. We've got Syria. There's news about Syria just coming through again this morning, and Iran. We've got tensions between China and Taiwan. What is the likelihood that there'll be another geopolitical event this year? And have you got any thoughts on potentially what that may be, given that you're quite close to that kind of media? So, Mark, if I can start with you, and other two, feel free to pipe in.
Yeah, well, I think you're right. You look back through history, and there's just a long list of events like that. You could add in Brexit. You can add in sort of, the issues with Greece and all the refinancing. And I think the lesson there is there's always something going on, usually a multiple number of things. You could have had me up here on this stage every January for the last 20 years, and every single year I would have been able to give you a long list of what could go wrongs. And yet 17 out of those 20 years would have been actually quite good from an investment perspective at least. So there's always something to worry about, and if you get too hung up on all the what could go wrongs and do nothing, you will get left behind. So unfortunately, I think we often do have to, fight against that natural human bias to get wrapped up in all the negative and still, have a foot in each camp. And this year is no different, whether it's the US election and it's headed for Biden versus Trump, and Biden's approval ratings are terrible, and if the US has a recession, then Trump's absolutely in the box seat. So, that's a possibility. What would that mean for trade tensions and all the rest of it? We know how it played out last time. This time, it'd be his second and final term. So, this would be the unconstrained Trump, which is quite scary, isn't it? The Middle East, obviously you're seeing sort of those three key trade routes, the Suez Canal, the Strait of Hormuz, the other one that I always forget the name of. That's 20% of global shipping or something like that. So there's risks everywhere. The Taiwanese election, you've got another pro-independence party having been elected, so the tensions are still there between China and Taiwan. So the list goes on, and I think the likelihood of further geopolitical risk or tension is high, if not sort of close to 100%, because there'll always be something. And in little old New Zealand, there's not much we can do about that. We can take action to best mitigate some of those risks and offset them, either as investors or as businesses or as a nation. But you've just got to work with them, because I think we are in a world where those tensions are going to be more elevated from here on.
Great, thank you. Thoughts from Sharon?
Yeah, well, coming back to an inflation lens again, things like the increased focus on economic security, reshoring, onshoring, friendshoring, that sort of thing is reducing the ability or the desire of firms and governments to go for the least cost. So it's a form of insurance, and it has a premium attached to it. That's inflationary. Also climate change, whether you're adapting to it or mitigating it, the same thing. It's inflationary either way. The storms that we're seeing and the repair bill for that, plus the building resilience into everything. Those of course are global things. So it was interesting to hear the Chief Economist from the Reserve Bank yesterday comment that you can spot deflationary things too. Obviously, China is looking at risk of getting stuck in a deflationary problem like Japan before it. So it's not all one-way traffic. But the list of potential inflationary problems for the globe is longer. If that's going to be the case, is it the case that you need to then screw down your domestic inflation lower in order to achieve the same inflation target? Or do you want to start thinking about what the inflation target should be? Is that the thin end of the wedge of the beginning of the end of inflation targeting? All of these sorts of really quite big picture issues I would expect to come more to the fore as these things unfold.
Mm-hmm. Thank you. Kelvin?
Yeah, not a lot to add. I mean, I'm a pretty domestically focused kind of guy, so I won't sort of rabbit on. It would end up subjective thoughts on stuff. But I guess a couple of things, like Mark said, there's always risks. So I mean, you just got to get on with it. It's just the natural state. And also, economies tend to grow. You tend to have a bit of inflation. This is the natural state. So within that, you just got to get on with it. And we focus, say, on rising unemployment. I don't know, it goes from whatever it is now, 4%ish. Let's say it goes to 5%. Everybody sort of frets. But that still means 95% of people have got a job. So, I just think, there's I'm an economist. I tend to have a sort of pessimistic slant. But, you lose sight of the optimistic side of things sometimes. And actually, there's always risks. Most people will keep their jobs. The economy tends to grow. So, get on with it.
A quick fire question. I'm going to ask you, Mark, ask you first, Kelvin, because you're New Zealand focused and it's an international question. Out of 10, chance that Trump becomes president in November?
Oh, jeez. I mean, I can't believe that's the two candidates out of. But I don't know, like 7.
7, Sharon?
Yeah, I'm thinking 7 or 8. It's looking likely.
Oh, look, I'm a bit more optimistic than that. I think if the US avoids recession, then Biden will probably keep his job. You look back through history, it's actually quite hard and quite rare to displace a sitting president. So for me, it comes down to what does the economic outlook look like. And I am a natural optimist, so I would say if the Fed doesn't muck around for too long and they get on with easing interest rates, as they should, because they're almost bang on their inflation targets. If they do that sooner rather than later and avert an unnecessary recession, then Biden will be re-elected. If they screw it up, then absolutely Trump is a possibility. But 7, geez.
So I'd put you down for a 3 then, Mark.
Oh, not that low.
That low?
Yeah, look, I think it's pretty close, but
50-50?
I'll give Biden sort of the slight edge. Call it 55-45.
Okay. A question from the floor here. New Zealand dollar. Where do we think that's going to be over the next 12 months, and what impact is that going to have on things like tourism?
Right.
Sharon, can I start with that?
Okay. Well, yeah, there's different forces. China's struggling, obviously, at the moment. They're our largest trading partner. How their consumers are going has a huge impact on our commodity prices. So the New Zealand dollar's actually been doing a pretty good job of doing the one thing it should or can do best, which is follow dairy prices and share the joy and the pain of whatever's going on there around the rest of the economy. So, yeah, the short answer is watch milk prices. But we do have this shadow hanging over us in the form of our current account deficit. So essentially, even though it was the public sector rather than the private sector that went on a borrowing binge, we have not been paying our way in the world, and obviously the loss of tourism for quite a long period didn't help that. So things are coming right, and part of that mix is a drop in consumption and investment, and therefore a drop in imports. Getting there, but not quickly, and we could get a ratings downgrade, and you'd expect that to give the New Zealand dollar a bit of a smack, hasten up the adjustment, but a harder landing potentially as things feed through than we're hoping for. Our forecasts are that it's not going anywhere fast, but it does tend to be quite correlated with global risk aversion. So if everyone's feeling relaxed, then they'll take a punt on New Zealand. If they're feeling nervous, they tend to bring their money home, and New Zealand's not home for much of the world's capital, so we tend to be the loser in that scenario.
Right. Thanks, Sharon. Mark?
Yeah, I think barring the global recession or some major risk event, which would then overwhelm all other factors, that would obviously lead to a falling currency. But putting that to one side, if you don't get that, I could actually see the Kiwi dollar remaining strong and pushing a little bit higher, because I just look at what's happening on the inflation and the interest rate front, and in the US, inflation's in the 2s, in Europe it's in the 2s. Those central banks look much more likely to start easing policy sooner than us. You know, we've still got that sticky domestic inflation. I know Sharon's forecasts and expectations are for, rate cuts later rather than sooner. So I could see some of those others moving earlier than us, and us being a little bit stubborn because we've got those inflation pressures. And if migration sticks around, growth probably, muddles through as well. So against that backdrop, I could actually see the Kiwi dollar maybe rising a little bit through this year.
Okay, thanks, Mark. Kelvin, any thoughts on this?
Not a lot to add. Like I say, it's kind of external thing. But I just say, I suppose the group who would say, we want a weaker dollar would be farmers. That would be the main thing. And I'm off the farm, so I kind of get it. But at the same time, input costs have been a big problem, and a stronger dollar will help with those input costs. So it's a two-sided thing. There's never a black and white scenario. So keep both sides of the equation in mind.
Okay, and if I can bring us back to inflation for a bit now, because you talked about inflation being a little bit sticky. There was a bit of a surprise downward in overall inflation, but non-tradables is higher than expected, particularly excluding housing. So what is driving that stickiness of non-tradable inflation? Is much of it caused by the terrible weather that we had last year that was driving food price inflation up? Or what's driving that non-tradable inflation remaining high, and what can bring it down?
Insurance costs part of it.
Ooh.
It's true.
Yeah.
And there's not much the Reserve Bank can do about that either. Sorry, Kim.
Yeah, no, I was just going to say, you talked about excluding housing, but, I'd add in the housing that we're seeing, big pressure on rents, especially in Auckland. I think on the latest numbers, you're kind of talking 9-10% rental growth in Auckland. Hard to know exactly why, but, at least prove it with stats, but we know immigration's going to be coming into Auckland. Council rates, that's a big part of it. Construction costs are still rising, they're not as quickly, but they're still a contributor as well. So outside housing, I'm not too sure. It's just that general pressure, I guess, going back with, the government debt ramped up, and, maybe there's too much money sloshing around. We've still got that domestic pressure. So, yeah.
Sharon?
The IMF estimated that New Zealand was the most overheated advanced economy in the world in 2022. 2023 as well, for that matter, but they might get different numbers because of the GDP revisions if they reran that analysis. But clearly, our economy was very, very overheated with a policy mistake, and in hindsight, it's a wonderful thing, from both monetary and fiscal policy, and also the supply shock of the closed border and the inability to bring in workers was massive. We had the tightest labour market we've ever seen. We have let in 250,000 permanent long-term That's an astonishing number. In the last 12 months, half that many have also gone out. So massive, massive churn, which does kind of grease the wheels of some of that inflation that Kelvin was talking about in the housing market, for example. But it also takes a lot of inflation pressure out of the labour market. So our working assumption is that the labour market is no longer inflationary, and that should start to feed through. And so by the Q3 on our forecast, we've got unemployment through 5%, still rising. We've got inflation back in the band, and therefore the Reserve Bank feels comfortable cutting. But there are, as Mark mentioned, some sticky things the Reserve Bank can't do much about. And again, it comes back to that debate of, is it worth it? I would expect that debate to get louder as inflation gets closer to, firstly, the target band, and secondly, the midpoint. How much is it worth squeezing that lemon to get that last little bit out? That debate lies ahead of us, and some of that debate will centre on the question of, well, which prices are still going up fast, and is that really the Reserve Bank's responsibility? They can't do anything about insurance costs, so should they hit something else harder to make up for it or not? And if they don't, then what does that mean? These aren't new questions, but I think they're going to be more discussed this year.
Mm-hmm. On that point of insurance, and fire in general in particular, there's a question from the floor here that NZIER yesterday called for hazard information to be open to all so that everyone can assess risk to property. What are your thoughts on that? Sharon, if I can start with you and then come to Kelvin, and then I'll have the next question for you, Mark.
Oh, I'd just say every buyer wants to know about the hazards, but sellers throw a fit if you try and put it on their limb. So, it's it's a fairly fraught question, I would say. You got any thoughts on this one, Mike?
I'm sure Kelvin's got some more considered thoughts than me.
Yeah, I mean, more information is good in my view. And I know I work at CoreLogic, this is kind of our thing. I know it's happening behind the scenes. I know from the Reserve Bank publications, there's more emphasis on the impacts of climate change, especially on property ownership near the coast, near rivers, this sort of thing. So I can say it's definitely going on, and it's going to become a bigger issue for sure. So, like I say, data, information, more of it, the better.
Yes, and the Auckland rainfall chart last year was astounding, right? If anyone was following that, if you Google it, 2023 relative to the last 65 years was just mind-blowingly out of the water. So we certainly have had some significant change. It's just as well as no climate change. In terms, Mark, of market events, last year it was really probably only 12 months ago that suddenly ChatGPT really exploded, right? And the Magnificent Seven, the largest 7 stocks in the S&P 500, which make up over a quarter of that market, were the best performing stocks. I don't know whether anybody would have predicted that, but what are your thoughts for asset class movements this year? Where do you think that?
Yeah, that's an interesting one. Look at my watch because I know Google and Microsoft are reporting in about 20 minutes, so we'll see if sort of they meet the bar. But the US is really interesting, and I mentioned 2 super strong markets right at the beginning. Japan up almost 30% last year, the US up almost 30%. But the big difference there was in Japan it was a broad rally with everything going up, and in the US it was a super concentrated rally. Those 3 sectors where the Magnificent Seven live, which is tech, communication services, and consumer discretionary, because they consider Amazon consumer discretionary. Those 3 just went through the roof, and the other 8 sectors of the US share market, I had a look at this yesterday, the other 8 sectors, so that's sort of financials and real estate and healthcare and all of them, have only risen by an average of 3% since the beginning of last year. So they've done absolutely zip. So I think it tells you 2 things as an investor. One, you can't ignore sort of those superstar sectors, even though they do look pretty expensive on some measures. So you sort of got to have a foot in that camp, because if you didn't have those, you got left behind. And I think the second point is when we look at the S&P 500 in the US, it's at an all-time high. Well, is it? It's only at an all-time high because of that small group that's risen. And there's the other 493 stocks. A lot of them are actually trading at quite modest levels, which is good from an investment perspective, because no one likes buying things at all-time highs. We like looking for opportunities. So a really interesting dynamic.
And what are your feelings on the correlation between bond and shares over the next 12 months? Because it's been a bit chaotic the last few years.
Well, I think they'll be quite well correlated. When interest rates went to zero and you had money printing everywhere, that pumped up asset prices across the board. So whether it's houses, whether it's bonds, whether it's shares, whether it's classic cars, whether it's antiques, pumps up the value in everything. And then as you get that reined in, that sees values come back down to earth. So now that you have largely seen interest rates come back up to, arguably sort of the top or roughly where they should be, I think that if you are hopeful of interest rate declines, then you will probably see fixed income assets and shares sort of lifted at the same time, unless interest rates come down because we have a recession. And that's the big debate. And I think that is probably one reason, if you were to sort of overlay, a risk adjustment or a probability sort of matrix over those two asset classes, you might be a little bit more positive on the more conservative ones, the fixed income ones, because they could do well under interest rates falling for the right reasons, but they could also do well if interest rates fall for the wrong reasons, which is that, we wind up in a more difficult economic spot.
Indeed. Okay, thank you. We've got a couple of minutes left, so if I can ask you all a final question and ask you, we've got about just under a minute for each of you. We're going to sit down for Outlook 2025, 12 months from now. This is going to tie back to one of your first comments, Sharon, about the uncertainty of comments. How accurate do you think today's predictions have been? Your predictions for today? What's the thing you're most confident about, and what's the thing you're least confident about? Kelvin?
Yeah, I mean, it's probably relatively safe. I'm pretty confident about that regulatory thing in the housing market. I mean, the consultation's open on LVRs, DTIs, it's going to happen. I mean, I don't think there's been any consultation that hasn't happened. So pretty confident about that. Like I say, a net impact on the property market, probably upwards. And least confident, I don't know, I guess maybe mortgage rates. I mean, who knows? It's dependent on the official cash rate. Do we have inflation under control? Offshore factors as well feeding into those longer term fixed rates. So yeah, I mean, I'm pretty cautious, so I'm thinking, maybe mortgage rates drifting down second half of the year, but sort of, plan for the worst, hope for the best thing. So, and those two things probably offset each other a bit.
Thank you, Kelvin. Mark?
I am confident that this time next year, inflation will be lower and that interest rates will be lower. I'm less confident about whether that will come at the cost of an economic mishap. And I'm not confident about trying to predict some of those geopolitical outcomes because I think they are just really unpredictable. Indeed. And it feels like there's more of them out there at the moment.
Absolutely. Thanks, Mark. Sharon, final word.
I'm like Kelvin, probably most positive, confident that house prices will be higher at the end of the year, even though they're currently falling. It's a bit of a strange one, but you can't let in 250,000 people into your economy and not see house prices lift. Even if the world turned to custard, these people have often come from poorer countries and they're here, come hell or high water if they can stay. So I wouldn't expect all those people to suddenly disappear. And interest rates, they could still go higher, but surely not much. So I think probably migration will win that one, though our forecasts are for only modest increases. What I'm least confident about, probably the timing of OCR cuts, even though that's my bread and butter of my job. We've got August in there, but you can imagine those sort of unpleasant scenarios you're talking about where they end up with cuts earlier, but you can also imagine scenarios where inflation gets stuck. We haven't had enough of the medicine, and then they could even go higher again, or at the least could end up being held high for longer than anyone's expecting currently.
Yeah, you shouldn't be too ambitious when the inflation rates are still well outside the target range, right? All it leaves for me to do is to say a big thank you to Sharon, to Mark, and to Kelvin. So if we can give them a big round of applause, please. Thank you.